Okay, we're going to get started. Good morning and thank you for joining today's webinar. I'm Dina White, the Director of Marketing at First Long Island Investors. First and foremost, we hope everyone is in good health and doing well. We have a lot of great information to cover today, so let's get started. I'm joined this morning by some key members of our investment committee. Robert D. Rosenthal, our Chairman, CEO, and Chief Investment Officer. Philip Malikoff, an Executive Managing Director and the Director of Research. Brian Gamble, Senior Vice President, Private Wealth Management. A few logistical items before we get into the webinar. All participants are currently in listen-only mode. At the end of the presentation, we will have time to answer questions submitted during the presentation, as well as questions we received in advance. Please feel free to submit questions during the presentation using the dialog box labeled Q&A. At this point, you should see a slide. Hold on, At this point, you should see a slide with the heading Today's Speakers. If you do not see this, please let us know by typing something in the chat area and we will help you troubleshoot. And finally, our General Counsel always asks that I remind you that today's session may discuss the performance of some strategies and that past performance is not a guarantee of future results. To the extent that specific company names or investments are mentioned in today's presentation, they are included as examples. Some, all, or none of these companies and investments may or may not currently owned or may have not ever been currently owned in FLI various strategies. Nothing herein is intended to be a recommendation to buy, sell any particular security or to invest in any particular strategy. Now we're going to begin the presentation and I'm going to hand it over to Robert Rosenthal.
Thank you, Dina. Good morning, everyone. Our agenda today is to just briefly discuss the results of the U.S. elections and possible implications, the U.S. economy, our current markets, a summary, and then a Q&A, which we hope will satisfy your knowledge and needs at this time as we are going through some volatility. We turn the page. Next slide. As you all know, at the end of each year, the beginning of the year, we issue a thought piece. And I am typically away the end of the year in some remote place. This past year was Southeast Asia. And I give a lot of thought to what we are going to see in the next year so that we can write a thought piece that gives our clients some direction. The title of that thought piece was 2025, Cautious Optimism with Some Unusual Uncertainty. Now, we've been doing this for a long time. As you know, FLI is 42 years old. And quite candidly, we've always had uncertainty in each year with going through different market cycles. However, this year, with a consequential presidential election, I thought there'd be some unusual uncertainty, and I have not been disappointed. Certainly, the shock and awe of President Trump's agenda early on this year has provided us with some volatility, which we will discuss. So let's go to the next slide. And here's just a picture of what you already know, that Trump received 312 electoral votes, Vice President Harris received 226, and he quite handily won the Electoral College. What was also a bit surprising, or not surprising that he would win, although the polls were very close, is that he also garnered a majority of the popular vote. And this is different from the last time he was elected back in 2016. So not only did he win the Electoral College, he won the popular vote as well, as you can see. If we turn to the next page, what is consequential and meaningful to us as investors is the House election results were quite close. So there is a very slim majority for the Republicans in the House. And with certain members of the House going into the cabinet of President Trump, that will make the majority even a bit slimmer. So we could be talking about a majority of maybe 2 or 3 House votes. That's consequential because given the extreme elements of both the Democrat Party and the Republican Party, no leader can count on, in this case, Leader Johnson, Speaker of the House, can count on assurances that every Republican will vote along with him and the president. And this leads to volatility that we may expect when it comes to any legislation. So again, there's more of a majority in the Senate, there's less of a majority in the House, and that is consequential in terms of being able to pass what President Trump calls the big, beautiful bill, which will include a great many items. If we go to the next page, also of note, and this is history, it's a guide, it's not a guarantee, that historically in the first year of a presidency, when January, the month of January, has been positive for equity markets, it's been a positive year. And that's the slide on the left, with a chart on the left of this slide. And that indicates that we had a very positive January, although February was rocky and March has started off a bit rocky. It should indicate, if history repeats itself, that we'll have a positive year. The slide on the right, or the chart on the right of this slide, is an indication of what typically happens in year one. And as you can see, through different cycles, 1928 to 2024, the average increase in year one of a presidential cycle was 7%. For the period 1961 to 2024, the average gain was 10% in year one. Right now, the S&P is probably slightly negative. So we have something to look forward to. And then you can see what the results have been on average historically in years 2, 3, and 4. But we're concerned right now with year one. If history is a guide and it repeats itself, then we should have a positive year, both based on the performance in January and what has typically happened in the first year of a presidential cycle. Again, this is history. It's a guide. It is not a guarantee, although we are cautiously optimistic, as our thought piece indicated, and that remains the same. If we turn to the next slide, this is more qualitative analysis as we see it. The president's focus includes some notable changes in what has occurred under the Biden administration. First, there is an absolute appetite for deregulation in technology, energy, and the environmental sectors. This is very pro-business. And in his first 6 weeks of being president, and with the cabinet members that he has assembled, he has already begun to deregulate and to try and spur small business on in particular. So we view this, industrial production has increased, and we were just on the phone with an analyst this morning talking about the potential for greater industrial growth in the US, and we're optimistic about that. So this deregulation in technology and in energy and the environmental sectors, we believe is very pro-business, and President Trump has indicated that he would eliminate 10 regulations for every new one that is proposed in his administration. That's an aggressive agenda, but we do believe this deregulation will lead to a pro-growth in business. Now, also trade and economic policies, including tariffs, which has been causing a great deal of volatility in recent weeks. His America's First trade policy is that tariffs should be honest, and they should be balanced, and they should be reciprocal. And what that means is if we produce a car in this country, which we do, and we ship it to Europe, Europe has a tariff on our coming in, but we don't have tariffs of an equal amount for cars coming into the United States from Europe, as an example. So Trump is now already banning about threatening and implementing tariffs against Canada and Mexico and China, which have roiled the equity markets the last few days. How inflationary this will be, we don't know. The duration of these tariffs, we don't know. Is he using the threat of tariffs and the initial implementation as a strategy to effect better control on the border or less fentanyl coming across? or some sort of reciprocal tariff arrangement so that American workers are not disadvantaged, only time will see. Many economists believe this will be somewhat inflationary. However, I would point out that in President Trump's first term, when he did invoke tariffs against China and substantial tariffs against China, his inflation rate for the 4 years averaged 1.9%. I would also point out that President Biden not only continued the tariff on China when he became president, but also slightly increased it. So both presidents in recent years have invoked tariffs to try and make things better. Now, promotion of onshoring is also very key. As we learned during COVID, many sources of supply were overseas. Given the geopolitical situation that we face today, unfortunately, we cannot guarantee that those sources of supply will continue to exist if we end up in geopolitical strife. So the president is very much into promotion of onshoring, bringing back the manufacturing of key needs to America, which will help American workers produce economic growth, may also produce inflation, but will also make us less dependent on foreign powers for various products. Also in the news recently has been the minerals, the rare earth minerals deal with Ukraine, which was not signed on Friday. We suspect it will be signed shortly, but that gives us access to rare earth minerals that many of which we've been getting from China. And you know, of course, that we are somewhat at odds with China. So the trade and economic policies indicated by President Trump in his first year include tariffs, which could be inflationary. We're watching that closely. Could create a trade war. We're watching that carefully, particularly with the companies that we own. Although many of the companies that we own have said they're going back to the producers to ask them for reductions to offset the various tariff charges that are being placed. We'll see how that all plays out, but it certainly creates a bit of uncertainty. The next area the president campaigned on was immigration and border policies. And I think our worst fears have yet to be faced. When he campaigned rather stridently that there would be a mass roundup of 15, 20 million illegal immigrants that were costing the country a great deal of money, creating crime, creating an expense to the American taxpayer. Thus far, I'm pleased to say that the illegal migration across the southern border is down to a trickle. So as he pointed out the other night, you didn't really need legislation to do that. You needed a different person at the helm. And his policies right now, at least, are reducing immigration. Whether they're reducing fentanyl, we don't know. Have there been, huge roundups of illegal immigrants, which we were all concerned about? That has not yet taken place. So and this, by the way, this policy of reducing illegal immigration over the southern and northern borders was very popular with voters and probably one of the reasons why President Trump won the election. But we'll wait to see what further develops in this area. Foreign aid and international relations. Well, obviously, foreign aid has been questioned by the president as it relates to Ukraine, although we believe that we must defend Ukraine or help Ukraine defend against the invasion from Russia, but there must be a reasonable conclusion to that conflict. And there's a reevaluation of U.S. aid, as you've read about. A lot of it has been wasteful. Now, I think we all know as American citizens that we're concerned about waste and fraud in spending by all people in D.C., Republicans, Democrats, Independents. Is there waste? Is there fraud? We believe there has been some waste. We believe that we have been funding areas of government and in foreign affairs that have not been necessarily smart and have not necessarily been helpful to the United States. We also must confront the fact that we as a country have almost $37 trillion in debt. That has to be faced at some point. So whether it's the United Nations participating in activities that are anti-American, or whether it's funding a Ukrainian war of attrition against Russia. Russia, without question, was the invader. Vladimir Putin, without question, is the dictator. He also probably has committed war crimes in the abduction of many thousands of children. So this whole area of foreign aid and international relations has to be reviewed, whereas the president has been cutting back or threatening to cut back aid to Ukraine. He has not threatened to cut back aid to Israel, which is engaged in a war with Hamas and Iran. So this is another area where we have to focus on and will create volatility, and where Congress will have to come together in order to continue to fund foreign aid and international relations where it's in the best interest of the United States. Next subject is government restructuring and efficiency. This goes back to my point of a few minutes ago or a minute ago, where we all believe that there's waste in the federal government on both sides. And that's something that has been the case with prior Democrat administrations and prior Republican administrations. And President Trump has created this Department of Government Efficiency led by Elon Musk. Elon Musk, who is the founder of Tesla and spaceship companies and X and a whole bunch of things. Without question, he's incredibly smart, incredibly entrepreneurial. And he has gone in and done something that many presidents have threatened to do. President Obama, President Trump in his first term, President Biden most recently, all suggested that the government could be more efficient, but didn't do anything about it. This time around, President Trump has empowered Elon Musk and Doge to go in and look for inefficiencies. And if you've read the news recently, you've seen that there were many inefficiencies that have been uncovered thus far. And Elon Musk and his team have eliminated many jobs, which in some cases were mistakes, which have been corrected. I had the privilege of having lunch with a congressman recently, and at lunch he was called by the head of a major, and this was Republican congressman, he had been called by the head of a major union, and the major union was the fireworkers union, and he was complaining, the chief was complaining that aid to workers that took care of people, fire people who were injured or took ill from 9/11 were no longer going to receive their aid because of these cutbacks. And the congressman I was sitting with then worked with another congressman, another Republican, to reinstate those people so that aid would not be cut off. So there are mistakes being made. The government will correct them, but in many instances, there will be some savings, which again, hopefully will change the trajectory of the debt that we have in this country. So restructuring and efficiency in government is a good thing if it's done fairly, if it's done with transparency, and if it's done with the knowledge of Congress. Under domestic policies, I won't spend much time on this, there's the termination of diversity, equity, and inclusion, DEI. And let's say the balance shifted from maybe too far to the right to too far to the left, and hopefully now it goes to the middle. Many companies have backed off on DEI initiatives or statements of it. We would hope that responsible managements of companies employ, without calling it what it is, DEI, employ diversity, equity, and inclusion in their decisions, but don't take away from the merit of people just for the strategy. But this is a policy of the president. We will see how it works out. Probably also very important to all of us on this call is the 2017 tax cuts and the Jobs Act set to expire the end of this year. Now, this is consequential. The Tax Act of 2017 increased the lifetime wealth transfer to almost $14 million per person. If this sunset at the end of the year, it will revert to approximately 7 million, which is a huge decrease. Also, the income tax rate, currently the highest rate is 37% for ordinary income or workers' compensation, and it may revert back to 39.6%. Also under discussion, something that we at First Long Island have been active in, is the reinstatement of or liberalization of the state and local tax deduction, which is now currently capped to $10,000. Prior to 2017, it was unlimited. So your real estate taxes, your state income tax, were deductions on your federal tax return. This was capped by President Trump at $10,000 in 2017 and hurt many people who work in New York, New Jersey, Connecticut, Illinois, California. It even hurt people living in Florida, where real estate taxes are very high. So this is something that we've been active advocates with both Democrat and Republican Congresspeople to try and get this liberalized. I can say at this point that there is some optimism. President Trump, in a speech that he made at the Nassau Coliseum prior to being elected, indicated that he was open to liberalization of the SALT deduction. We've been in touch with certain Democrat and Republican Congresspeople to make sure that they're behind this effort, because with the tax burden in New York in particular, this would be very helpful on an after-tax basis. These are some of the areas that we think are the focus of President Trump and his cabinet. He is in alignment with the majority in the House, although it's very slim. And there are some very, let's say, conservative people in the Republican Party who may not go along with all of the things that I've just mentioned. Only time will tell. But there's a lot on the table that needs to get accomplished from a tax standpoint that will affect us as investors. And we're hopeful that the 2017 tax cuts will be extended. And there's a debate whether they are extended permanently or they're extended for a period of time so they don't create a much bigger deficit in the country. And we are actively trying to lobby state Congress people, both on both sides of the aisle, to liberalize the SALT deduction, because 10,000 just doesn't cut it, and going to 20,000 doesn't cut it either, but we will see. So that's some of the items that we're concerned with as investors. These are some of the things that have caused volatility in the market, particularly tariffs right now. And that's why we remain, and you'll see with my partners presenting, that we're confident that earnings were going to go up. We're confident that inflation will stay where it is, or probably trend a bit lower. And if that's the case, and we can get through some of these items in Washington and maybe solve some of the strife that exists geopolitically, we're going to have a decent year. So we remain cautiously optimistic with, as I said, some uncertain conditions caused by President Trump's aggressive agenda. And with that, I'll turn it over to Phil Malek.
Thank you, Bob. So every Tuesday morning at 9:30 sharp, our 9-person investment committee meets to discuss the economy, the Federal Reserve stance towards interest rates, politics, corporate news, and how they could affect the stock and bond markets. Today, I'm going to share some of our insights and some of the charts and statistics that we look at to determine how the economy is performing and how we believe it will perform in the future. At a very high level, the economy is doing pretty well. Inflation is moderated from its highs in 2022 and stabilized under 3%. The labor market is robust. The housing market is solid, and consumers are in relatively good financial shape as household net worth has soared. I'll have more details on these shortly, but let's start on this chart by looking at the Federal Reserve and interest rates. So we all know that the Fed aggressively raised interest rates throughout 2022, as we can see in this chart. There were 7 rate hikes, which took interest rates from effectively 0 to 4.25% by year end, and followed in 2023 with 4 more hikes, bringing the Fed funds rate to 5.25%. But last year, in early September, the Fed reversed course and began a cycle of lowering rates, cutting for the first time in 4 years. It followed up with 2 additional cuts before year end, bringing the Fed funds rate back to 4.25%. The Fed is very data dependent and uses economic data in its forecast. So on this page on the right, we can see what's called the Fed's dot plot matrix, where the Fed's current plans for future interest rate moves are shown. The Fed's forecasts are represented by the yellow dots, while the Fed funds future markets forecasts, which is where the investing public predicts rates will be, are shown by the green dots. These dots show where each expects rates to be at year-end 25 and year-end 26. So the Federal Reserve has plotted that they expect to continue lowering rates this year with 2 cuts and 3.75% as their target. And this is as of the last Fed meeting in early February, and will be updated at their upcoming meeting in a few weeks. However, the futures markets are predicting a more aggressive Fed with 3 cuts this year and a target of 3.5%. In 2026, both believe the Fed will continue to lower rates, with both the Fed and the futures market seeing 3.25% as the year-end forecast. At First Long Island Investors, we believe there will be 2, maybe 3 cuts this year. However, any significant change in economic news, specifically increasing inflationary trends or geopolitical events, can quickly and drastically change those projections. But at the moment, it appears that the Fed will continue to be friendly, and a friendly Fed has typically been good for equities and fixed income. Let's go to the next page, please. So on the next chart, we can see how the economy, as measured by gross domestic product, or GDP, has been performing since 2019. The first thing you're going to notice is how GDP reacted to the COVID pandemic. These are the big up and down lines. And the COVID pandemic, which began late in the first quarter of 2020. During the second quarter that year, as people sheltered in place, stayed home, GDP fell to 5.5%, and followed that up by declining 28% the following quarter, putting the economy into a recession. As things improved later in the year, the economy expanded by 35%. Now, these are massive numbers. They haven't been seen since the Great Depression. Typically, US GDP numbers top out in the mid-single digits, 5, maybe 6%. But since then, the economy has stabilized, with quarterly readings averaging about 2.8% over the past 2 years. Projections for the next few years see GDP growth of about 2%, which is really a good place to be. It's not too hot, where inflation can become an issue, but it's strong enough that a recession isn't a concern. And speaking of recessions, FLI has not been in the recession camp over the past few years. In spite of many well-known economists and large investment firms predicting recessions in 2023 and then again in 2024, we just never saw it. We have entered an era of rapid technological change driven by advancements in artificial intelligence and the build-out of data centers, many costing over $100 billion. A group of just 4 large technology companies are expected to spend over $320 billion in capital expenditures this year. We expect that all of these investments should support domestic expansion, even if it is at a slightly slower pace. So once again, we're not anticipating a recession this year either, barring an unforeseen exogenous event. Let's go to the next page, which is inflation. So inflation has been in the news since the COVID pandemic, when it rose precipitously. This chart on the left shows both the Consumer Price Index, or CPI, which is shown in the blue, and the Core Personal Consumption Expenditure Index, known as Core PCE, and that is shown in green. Core PCE is important as it is the one measure that the Fed uses to gauge inflationary pressures in the economy. The Fed has a 2% target for this measure, and pre-COVID, it was under that level. However, when COVID hit, both CPI and Core PCE soared, with CPI reaching 9% in June of 2022, and Core PCE topping out at about 5.5%. A good portion of this shocking rise was due to the government providing stimulus checks to individuals and businesses to help them as the economy declined, as well as massive spending on new fiscal programs designed to prop up the economy. As Nobel Prize-winning economist Milton Friedman said, inflation is always and everywhere a monetary phenomenon. So in English, what that means is when there's more money floating around, and there was at that time period, inflation is certain to follow. So that was definitely the case in 2021 and 2022. However, since that period, the CPI's trajectory has reversed, declining almost as quickly as it rose. Year-over-year inflation has retreated, stabilized, and moderated in a range of 2.5% to 3% since last June, while the core PCE has been in a tight range around 2.7% since July. While these levels are a bit higher than they have been historically, inflation by both measures has slowed and isn't currently showing any signs of pushing significantly higher. Core PCE, while not quite at the 2% level, it is close, and that may mollify the Fed, at least in the short term. The chart on the right shows three measures of the cumulative effects of inflation. The dark blue line, which shows what is known as the common man inflation index, includes necessities such as food, energy, shelter, clothing, utilities, and insurance, and that index has risen by 30% since 2018, following a spike higher in 2021. A very large portion of that was due to shelter costs, which have risen sharply over the past few years. The lighter blue line is the employment cost index, which is a measure of workers' income. While that too has risen since 2018 and was pretty much in line with the common man index through early 2021, these two indexes diverged after that. Earnings have not kept up with the cost of necessities over the past 4 years. The green line measures discretionary items, and while they have risen about 21% since 2018, employment income has outpaced the cost of discretionary items. One item which has been featured prominently in the news recently is the price of eggs, which have risen sharply due to an avian flu epidemic and has greatly reduced the supply of eggs. However, what is flying under the radar and not mentioned in the news are items which have seen price declines, which offset items undergoing price uncertainty. Some such items are cotton, which has declined by 28%, sugar by 17%, and heating oil by 13%. President Trump has indicated that he will attempt to reduce inflation through an aggressive energy drilling agenda, as well as reducing regulations on many businesses. The impact of these policies remains unclear at this point, but should his plans be successful, we could be settling into a period of lower inflation. Let's go to the next slide. So on the other hand, one of the wild cards for inflation is the effect of President Trump's tariff policies, as Bob mentioned. And these policies are changing day to day with the ultimate outcome unknown. As a background, a few days ago, President Trump instituted 25% levies on our neighbors, Canada and Mexico, with an exception for Canadian energy, which will carry a 10% tariff. China, which had a 10% tariff for many years, now has a 20% tariff on imported goods to the US. And just yesterday, the president issued a 1-month exemption for automakers following Commerce Secretary Howard Lutnick negotiating with Canadian and Mexican officials. This is going to be an evolving and fluid situation. And what is in place today could look very, very different a month or 3 months from now. However, trade policy is a tit-for-tat game, and we should expect reciprocal actions from those countries which are affected. Already, China has reacted by announcing retaliatory tariffs. Canada has imposed 25% tariffs, and Mexico will announce their response this weekend. Economists believe that American importers will likely pass along any added cost to consumers, meaning that individuals are likely to see higher prices, primarily at the grocery store and car dealerships. When we dig just a bit deeper into the details, we can see that the effects of the current tariffs may not be that burdensome. So the chart that we're looking at shows what percent of imports, which are on the left, and exports, which are on the right, are as a share of GDP for a number of countries. For both imports and exports, the US numbers are comparatively low. For the US, all imports make up only 8% of GDP, and those from China less than 2%. The majority of the 8% is comprised of imports from Europe and emerging markets, excluding China, which includes countries such as Vietnam and Indonesia. As far as exports, there is even a lower effect, as exports comprise about 5% of our GDP, with China being less than 1%, and once again, the remainder being Europe and emerging markets, excluding China. Let's move on to the next slide, which is employment. So in order to have a strong economy, it's essential to have people employed and earning an income. I'm happy to say that job growth in the US remains strong, with 2 million jobs created last year. The unemployment rate over the past 2 years has been in a range of 3.5% to 4%, and those are historically good numbers, as the long-term average is 5.7%. The unemployment rate is now back to it was before the COVID pandemic caused many businesses to close or downside, leading to nearly 15% unemployment at its peak. Total employment in the US is about 170 million people, and there are about 6.8 million unemployed workers. We will get an update tomorrow morning as unemployment news will be released at 8:30 with expectations for about 160,000 non-farm payroll jobs to have been created and the unemployment rate to remain at 4%. One of the things that we read in various economics reports is that companies of every size and industry, of course, nearly every state, are having trouble finding enough workers to fill open positions. Currently, there are about 8 million advertised job openings, and as we said, about 6.8 million unemployed. You can see that in the chart on the right, which compares the number of unemployed to the number of job openings, otherwise known as the JOLTS number. And while this has come down from its high of 2.0 in mid-2022 to about 1.1 now, it remains high historically. And just to put this in perspective, if every unemployed worker found a job, there would still be over 1 million unfilled jobs. And of course, every job requires a certain level of expertise and or experience, and job location is important. So it isn't really realistic. But the bottom line is that companies are looking to hire and people want to work. So that's a positive for the economy. Let's talk about the economy. So over the next few pages, we have a number of charts that show that the consumer is in relatively strong financial shape and is more affluent than they have been in the past, although they are saving a bit less and taking on more debt. So on this page, we can see that household net worth has surged to $169 trillion from under $100 trillion just 10 years ago and under $50 trillion at the start of the century. During the pandemic, there was a small pullback in this figure, but due to government-issued stimulus checks, asset inflation, and a surging stock market, household net worth has soared since then. In the chart on the right, you can see the jump or bubble in household assets that occurred during late 2020 and throughout 2021, as those stimulus checks created a major distortion. Assets rose way above the trend line that goes back to 1952. But this asset bubble popped in 2022 as the stock market pulled back and rising interest rates drove down the value of fixed income assets. Household assets, which have been well above the green trend line, are now back on trend, and that trend is growing about 4% a year. On the next slide, on the left, is consumers' personal savings rates, which spiked during the stimulus-induced inflation during the pandemic as consumers stopped shopping. However, once the economy opened back up, consumers had enormous pent-up demand and spent extravagantly on luxury goods and experiences. All of this spending drew down their savings. The personal savings rate is now 3.8%, a bit below the 5% average over the past 25 years, if you exclude the sharp rise in 2020 to 2021. People are spending, and since the consumer makes up about 70% of our GDP, they are helping to keep the economy growing. We can see how consumers are spending in the chart on the right of this page. Real personal consumption, which means net of inflation, is currently rising 3.1%. This is the fourth consecutive monthly reading over 3%, the first time this has happened since early 2022, and up from the low of 1.3% in late 2022. Real PCE has averaged 2.3% over the past 20 years, including the big swings that you see in 2020 to 2022. So recent readings are above trend. So how are consumers paying for all this consumption? Let's go to the next slide. We've seen that they're saving a bit less, so it's not from savings. The answer is that they're taking on more debt, primarily via credit card balances. Now, all forms of revolving consumer credit have risen from about $1 trillion in 2020 to almost $1.4 trillion at year end, of which credit cards account for over $1.2 trillion. This has led to higher household debt service, which is shown on the right-hand chart. Debt service is 11.3% of income, Not a historically high number and slightly under where it was from 2012 to 2019. In summation, the Federal Reserve is dovish, and just at the start of lower interest rate cycle, the economy is expanding, the job market is strong, inflation is under control, and the consumer is in good shape. All of these are positives for equity investors. I will now pass it on to my colleague, Brian Gamble.
Thanks, Phil. All right, so Bob and Phil covered the latest on politics, policy, and the economy, and I'll now give an update on current market conditions and why we remain cautiously optimistic. As a reminder, as part of our investment process, two of the major things that we focused on are interest rates and earnings. Phil obviously already covered our outlook on interest rates and the market's outlook. On this slide, you can see the historical in blue and projected earnings in green of the S&P 500. With an economy growing at a reasonable rate, which Phil described earlier, this should support reasonable earnings growth going forward. Last year, earnings grew approximately 11%, and consensus most recently estimates earnings to grow 12% in 2025 and 14% in 2026. While we think those growth rates are probably a bit ambitious, we still believe earnings are likely to continue to grow at a reasonable level, which is supportive of a rising market. As many of you know, part of our process is to seek out companies that have the ability to consistently grow earnings, and we continue to do that. Next slide, please. On this slide, you see the PE ratio, next 12-month PE ratio for both the market cap weighted S&P 500 and the S&P 500 equal weighted index. While not cheap, we believe current valuations are reasonable in light of the continued earnings growth and reasonable interest rates, especially in regards to the equal weighted. Another thing that we've been looking at here too is index composition, which we'll get into in a minute. But we think, given some shifts in the composition of the index, that structurally higher price to earnings ratios for the index may be warranted. You can see here, starting in 2020, that the spread between the cap weighted and the equal weighted started widening as market performance became more concentrated in the Magnificent Seven, reaching its peak at the end of 2024. Since the calendar turned to 2025, the spread began narrowing as market returns have started broadening out. Next slide, please. So I mentioned the Mag 7 on the previous slide. Mag 7 are some of the largest technology-oriented companies in the world that are leading many secular growth trends, some of which I'll discuss later. Mag 7 consists of Apple, Amazon, Alphabet, the parent company of Google, Microsoft, Meta Platforms, or the old Facebook, NVIDIA, and Tesla. So the Magnificent Seven dominated index returns over 2023 and 2024. You can see that in the chart on the left. The divergence in the performance between the indexes is solely attributable to those companies' outperformance over that time. This outperformance led to the 10 largest companies, which include the Magnificent Seven, making up a material higher weight in the S&P 500 as compared to history. You can see that on the right, with the top 10 making up about 36% of the index, although slightly off the record high of almost 39% that was set at the end of 2024. Moving on to the next slide. Here's a look back historically at the top 10 companies over the last 35 years within the S&P 500. As we saw in the previous chart, index concentration is near an all-time high. What's unique about the current market, though, is that the concentration is also much more concentrated, not just in position size, but within technology-oriented companies than what we saw historically. You can see, going back to 1990, 2000, 2010, you'll see that, they were much more diversified, industry-wise, it was a much more diversified top 10 than what we're seeing now in terms of the technology-oriented companies. An important trend to note, though, is that companies that typically appear in the top 10 at the beginning of a decade typically have not remained there. Looking at this chart, if you see only 3 companies that are on this screen appear in 3 of the 4 examples we're utilizing. You can see ExxonMobil, which is there in 1990, 2000, and 2010, General Electric across the same time frame, and then Microsoft in 2000, 2010, and 2024. We'll see if this time is different, as the companies dominating the top 10 today are in a much different strategic position than those that we saw in the past. These are many asset light, patent protected companies that have created new markets in a lot of cases and typically own those markets with less competition than when others experienced in the past. And you're seeing that with the performance as well. So on to the next slide. All right, so another trend that we've talked about in the past and still, warrants a discussion is the trend between growth and value. On this slide, you can see that the blue lines represent periods of outperformance or quarters of outperformance for the Russell 1000 Growth Index relative to the Russell 1000 Value, and the green bars represent periods of outperformance by the Russell 1000 Value. The market typically goes through extended periods of style outperformance where either growth or value outperforms. Cumulatively, growth has outperformed value since the Great Financial Crisis, with that trend becoming even more apparent over the previous 2 years, as we discussed with the Magnificent Seven. Prior to that, value outperformed through the early and mid-2000s, and prior to that, growth outperformed in the 1990s. Now, so far to start this year, you've seen the switch flip, and value is now once again outperforming growth. Style leadership can shift quickly, and it's not always easy to determine which style will lead for any particular year, and that's why, in our opinion, it is important for clients to have exposure to both styles as part of a prudent, diversified, and customized asset allocation. Next slide, please. Okay, so within that, we're often asked about areas in the market where we see opportunities. As a reminder, when we're looking for growth companies, we're looking for companies with durable secular growth stories. And when we're looking for value companies, we're looking for inexpensively valued companies that may also include dividend paying and dividend growing companies. We tend to focus just overall on companies that are high quality, have dominant market positions and may be taking market share, have strong management teams, and clean balance sheets. We've categorized some of the opportunities we see into 3 areas: technological advancements, lifestyle evolution, and industrial innovations. I'll touch briefly on a couple in each category. Technological advancements include themes such as generative AI, data analysis, cloud computing, software as a service or SaaS, and cybersecurity. Generative AI, which has garnered a lot of buzz in the media, allows computers to learn from experience and in many cases perform human-like tasks more efficiently and less expensively. Many companies view AI as necessary to maintaining their competitive advantage and are investing accordingly. Cloud computing, despite no longer being a new technology, is still a significant area of growth. In order for companies to utilize newer technology, like generative AI, their data must be formatted and organized in such a way that AI can read, analyze, and utilize it. One of the first steps necessary to utilize AI is to migrate data to the cloud. It's estimated that less than 50% of enterprise data workloads have been migrated to the cloud at this point, and only 10 to 20% of corporate data has been properly prepared to be utilized by generative AI. This leads to a huge potential runway for both cloud computing and generative AI as we continue to move forward. Additionally, cloud computing is a subscription-based service, as is a lot of the software that allows customers to utilize generative AI. This creates recurring revenue streams for both cloud and software companies that is attractively valued in the market. Companies exposed to technology advancements include NVIDIA, Microsoft, Salesforce, Accenture, Alphabet, Workday, Fortinet, and many others. There are a number of advancements also helping to improve our lifestyle, whether that be by making life more enjoyable, productive, or healthier, amongst other ways. This includes themes such as digital payments, online advertising, disruptive digital platforms, and healthcare. Digital payments consists of an area of growth continues to be an area of growth despite having been around for some time. Surprisingly, globally, there are still a significant amount of transactions that are completed with cash and checks, which remains an enormous opportunity for those involved in digital payments, including both business to consumer and business to business payments. There are an increasing number of ways that digital payments can be made, whether that be through credit and debit cards, mobile wallets, or electronic transfers. Disruptive digital platforms have revolutionized several industries by providing a dedicated service within a closed ecosystem. These platforms typically make it easier for users to utilize these services in a more seamless and customizable manner than legacy service providers. Disrupted industries include ride-hailing, vacation rentals, and media consumptions. Companies exposed to lifestyle improvements and trends include MasterCard, Visa, Meta Platforms, Amazon.com, Uber Technologies, Airbnb, Netflix, Eli Lilly, Abbott Laboratories, and Intuitive Surgical, among many, many others. A number of opportunities within the industrial economy include themes such as reshoring manufacturing, which Bob mentioned earlier, aerospace, infrastructure and grid modernization, which is necessary, and automobiles. Deglobalization and reshoring of manufacturing from overseas has become strategically important as geopolitical turmoil has increased over the last several years. Dependence on countries that may be considered bad actors for mission-critical supplies is no longer tenable. This includes medical devices and medicine and technological manufacturing. The government has enacted legislation in an effort to incentivize companies to increase manufacturing capacity both in the US and in friendly nations. This includes the CHIPS Act, which was passed a few years ago. Increased investment in infrastructure and grid modernization is also a key theme, where the increased need for electricity, driven by data centers, AI, and electric vehicles, is leading to a need for a smart electric grid that can more efficiently balance electrical load requirements, in addition to the need to update aging infrastructure, some of which has outlived its expected useful life. Companies exposed to these trends include Eaton, Taiwan Semiconductor Manufacturing, Fastenal, AbbVie, TransDigm Group, Howmet Aerospace, GE Vernova, NextEra Energy, Illinois Toolworks, and Tesla. Many other areas of opportunity exist in other segments of the market as well, including within financials and consumer staples. And with that, I'll turn it over to Bob for the summary.
Thanks, Brian and Phil. With a slim majority in Congress, enacting a legislative agenda will be challenging and could add to market volatility. We're actually facing a government shutdown, and as I mentioned earlier, certain tax provisions will sunset at the end of the year, and if nothing is extended or changed, that could lead to tax increases. So we're hopeful that Republicans and Democrats will come together and avoid a government shutdown and also be responsible in dealing with tax policy going forward. We believe inflation will continue to moderate, with the overall trend remaining downward. However, month-to-month volatility persists, and inflation in certain sectors may remain sticky, impacting consumer spending. And as Phil pointed out, you've got eggs because of the avian flu, where we destroyed a large part of the chickens that lay the eggs. And housing have been recent culprits in keeping the inflation a bit higher than we would have hoped. Hopefully, both of those situations will resolve themselves. Despite a declining inflation rate, prices remain elevated. We believe the most likely direction for short-term interest rates will be lower, but the Fed will remain data dependent as it balances its dual mandate of price stability and maximum employment. And as Phil pointed out, we think there'll be maybe one interest rate cut, possibly more. We'll see what happens with that inflation. And by the way, our colleagues over in Germany are borrowing money to grow their economy, and the European Central Bank just reduced rates this morning yet again. So from a global standpoint, rates are going down in some places, and Europe is becoming more aggressive in its spending and borrowing to do that in order to confront their needs from a defense standpoint, probably against Russia. Our economy remains resilient, with consumers in relatively strong financial shape, as was pointed out. Debt levels are still below historical peaks. Employment in the U.S. remains robust, and wage growth continues to outpace inflation. And that's really important, because what happened for a period of years when inflation peaked, primarily because of government spending in the aftermath of COVID, wages did not grow at a greater pace than inflation, and that hurt the consumer. It's now the reverse, where wages are growing somewhat more than the inflation rate, and consumers will catch up if that continues. Business conditions are favorable, and earnings growth is projected to continue over the next few years, which is key to our basic investment philosophy of trying to invest in companies and real estate for that matter, that grow their cash flow, grow their earnings, and we expect that will continue. And we hope that continues under the backdrop of inflation being more tepid and interest rates coming down. Now, while valuations are not cheap, they remain reasonable. And I think the points that were made on the makeup of the S&P 500, the change in the type of companies that make up that index or make up the companies that we invest in, those that are asset light, patent protected, dynamically growing companies are more prevalent today than they were, say, back in 2000, when technology companies led the stock market. But many of those technology companies had no earnings or barely had earnings, versus today, where the technology companies that are the largest companies in the world have huge earnings growth and earnings and solid balance sheets. So we're happy with that. Index concentration is something to be monitored, but what makes this time different is these are real companies, as I stated, with real earnings in secular growth trends that are not trading at astronomical valuations. And again, we've done a lot of work on, should the S&P average multiple be 18 or 20 with an interest rate of 4.5%? And again, it's our feeling that given the types of companies that are leading the world in earnings growth, that PEs probably should be a bit higher than they were historically, and those that are trading with much better fundamentals than the average company should be trading at a premium to those companies. So whereas we do see, the cap-weighted S&P index a bit higher than we would like, on an equal weighted basis, we think things are very reasonable. And again, if you own a durable growth company that's going to consistently grow their earnings over the next several years, their valuations, in our opinion, are reasonable. As pointed out, growth has outpaced value in aggregate over the last 17 years, and that trend has reversed so far this year, where value is outpacing growth. And by the way, international is outpacing the domestic indices for the first time in many, many years. And we do have some exposure to internationally domiciled companies in several of our strategies. These trends tend to move in cycles, but can switch quickly, so it makes sense as part of a prudent asset allocation to have exposure to both styles, as we are seeing in this quarter. And I keep using in many of the things we write bookends. We have the growth on one side of the book, one bookend on one side, and we have those great dividend growers and very stable, more mature companies on the other side, and then things in between. And that gives us proper diversification in our view, such as when value companies are more in favor, which they are right now, we and our clients participate. And as international picks its head up after being in the doldrums for so many years, we also have a bit of exposure there. So that diversification helps. The US government has approximately half of its marketable debt maturing over the next 3 years. This is a disgrace. We believe this was a policy error, as the government should have capitalized on low interest rates in 2000 and 2021 to extend maturities. This could add to market volatility and possibly higher interest rates down the road. Many of the companies that we invest in who were really smart, even if they didn't actually need the debt, took on debt at very, very low interest rates during the 21-22 period. And they're sitting in a very good position right now as they utilize some of those monies to expand their businesses. Unfortunately, the US government didn't do that. So that's why the focus on our debt and bending that curve down in terms of annual deficits is really important, because the debt service for the United States now has reached a pretty high level, probably equal to our defense spending, which is a bit of a concern. So we need some good work in Washington to stem the spending, to root out the waste, so that we can bend the curve on our annual debt. Ongoing global conflicts, Russia, the Ukraine, Israel and the Middle East, Iran, China, and heightened domestic political tensions remain key risks that require close monitoring. We need better cooperation in Washington, D.C. We need better transparency. Excuse me. And we also need to see the conflicts that are costing us a great deal of money and many lives in Russia and the Ukraine, in Israel and the Middle East, in particular, be mitigated or reduced. And also, we need to confront China on its aggressive nature. And hopefully, President Trump can do that without any warfare or whatever. He certainly was able to do that in his first term. Hopefully, he and the cabinet can do that in the second term. But we're watching these domestic and geopolitical tensions rather carefully. Now, having said all of that, as we started, we remain cautiously optimistic. There is unusual uncertainty caused by the political change in Washington and by the geopolitics. But as we pointed out throughout these presentations, earnings are continue to grow. We think inflation will come down. Interest rates will remain moderate to trending down. And that is a cautiously good environment for us to be in for the types of investing that we do. And with that, I'll turn it back to Brian and Dina to take some questions if we haven't answered them already.
Thank you very much for the informative presentation. We're now going to begin the question and answer session. And unfortunately, we've received multiple questions and we will not have time to answer all of them, but we will touch base with you if you submitted a question so we can follow up with you on a personal basis. So the first question, Bob, is what has led to the strong start of international equities?
That's a good question. When you've been out of favor for probably 15 years, and as Phil pointed out, we track every Tuesday morning, we have an investment committee meeting, and we look at the various asset classes to see how they've done. International has done pitifully over the last 15 years or more. And valuations, as the U.S. indices, U.S. markets have taken off, particularly led by technology companies, have left the international companies, many of which do business in the United States, just as many domestic companies do business overseas, have left them with valuations that are attractive at this point. And it's also a flow of funds. So as the dollar changes, the dollar is weakening now. It makes international investing a little bit more attractive. And there's a shift of funds to international. We don't know if that will continue. As we stated earlier, we have some diversification with a modest level of international investment so that our clients take advantage of that. But we have downplayed it over the years, and that has worked very, very well for us. But right now, the Europeans in particular are cutting interest rates. And Germany, for the first time, a very conservative nation economically, announced a major borrowing to grow its businesses, grow its defense capability. And that's considered positive for the European economy. So that's perhaps why international is starting to get a bid, so to speak, and actually leading all major indices this year in terms of performance. And we also see opportunities in emerging markets. And we look at that when we study various companies that we research. So that, Dina, that's probably why international is doing better.
Bob, I'd like to add something to that. And I think, there's a big difference between what makes up the domestic indexes and the international indexes as far as growth. And, there's a lot of technology, there's a lot of innovation that goes into a lot of American companies that you just don't see outside of the US. So, the growth rates are very different. This year has not favored companies that have bigger growth rates. In fact, of the Magnificent Seven, only one of those seven companies is up for the year. And so, you mentioned the catch up, but I also think the fact that Europe in particular has more mature companies, that is more favorable to global investors at the moment.
One last thing I would add to that is that, as we've said, value companies are doing better in the U.S. this year than the growth companies, including the MAGA 6, let's say, or actually 5. Only one, as Phil pointed out, is up. You have more value companies in Europe and elsewhere around the world. So the bid is right now to the value companies, including those internationally.
Thank you for that. Ralph, the next question's for you. Are the companies you invest in being more conservative given the uncertainty around actions the new administration will take?
Thank you, Dina. Yeah, I think from what we've seen so far, I think most prudent, good CEOs at the beginning of a year are always expressing conservatism because they'd rather be heroes at the end of the year than the beginning of the year. And from what we can see, the earnings for the fourth quarter came in very, very good. These are the companies that we own, not necessarily the overall market. But for the companies that we own, the earnings were very good. And the guidance in some cases was light, and in some cases was right on. But in the cases where the guidance was light, I think the CEOs are being prudent in trying to put the bar a little lower based on the uncertainty that exists with respect to the various things we talked about on this webinar, whether it be the tariffs and what effect they will have, whether or not how effective DOGE will be, and how that will eventually affect the economy in terms of all the layoffs that take place, the conflicts around the world. So at the end of the day, I think any prudent CEO is going to say, okay, I'm in the first quarter of the year. We got a long way to go. Let's be prudent. Let's set the bar a little lower. And, you know, if we have upward surprises in the next couple of quarters, fine. But we don't want the market to be caught short in terms of that. So most CEOs that I've been associated with over the years, and there have been many of them, will take that route. You always have the one or two CEOs who really take the bar to a different level and then they disappoint. Well, the market doesn't like that. Market likes a little more certainty, and the market, quite honestly, would rather see companies lower the bar. It's painful when it happens because the market, being the kind of market that it is, will punish those companies initially. But eventually, what will happen is when they start beating the estimates in the second, third, and fourth quarter, the stocks will respond.
Thank you, Ralph. So I'm going to wrap it up. That was the last question that we had time for today. On behalf of the entire FLI team, I would like to thank everyone for joining us, and I hope you all found this session interesting and insightful. If you have any friends or colleagues that you would like to invite to future events, please let us know, and we'd be happy to include them in an invitation. For the clients on the line, I would like to remind you that our investment committee is always available to discuss your individual asset allocations. Just please give them a call. And everyone have a great day and stay healthy.
Thank you, everyone.